Gold is struggling to hold above 5.2k an ounce right now, but silver just exploded nearly 6% in a single day. But why? The real reason silver is surging while gold stays flat is because the paper silver market is breaking. My name is Nick. I've been a professional investor and unprofessional trader for 24 years. Today we need to talk about the massive anomaly in the silver market and what the smart money is quietly doing behind the scenes. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any assets, and most importantly, do not take financial advice from some random dude on YouTube. Let's figure this out together. So right now, retail traders are completely mesmerized by geopolitical headlines. We have a massive escalation in the Middle East, the Iran war, tanker transits through the Strait of Hormuz are plummeting, and oil is going absolutely crazy, up, down, up, down. Naturally, retail sees silver rocket up past $90 an ounce, and they think that this is just a simple fair trade, a safe haven trade. They assume gold and silver are always moving together during a war. But gold has been essentially flat, dropping back down to around 5,100, while silver is acting like a completely different asset class. Why? This is the iShares Silver Trust ticker symbol SLV. Right now, it is trading at a massive 3.55% premium to its net asset value. Now, if you don't know how ETFs work, let me translate all of this for you. Whenever an ETF's price deviates significantly from the underlying assets it holds, Wall Street's authorized participants step in. They assemble a basket of physical silver, create new ETF shares, and pocket the difference as risk-free arbitrage profit. It's a self-policing system designed to keep the paper price pegged to the real price, right? But right now, that premium is sitting above the normal threshold. It's at 3.55%. The arbitrage mechanism is failing. Why? Because to create new SLV shares and collapse that premium, these institutions actually have to find physical silver to deliver to the fund in London, and they just can't. Look at the official depository statistics from Comex vault. In a single 24-hour period recently, the exchange reported a negative adjustment of over 3.2 million ounces in the registered category. Registered silver has declined by over 20% in the last 30 days alone. The paper leverage in this market is currently sitting at 6.9 to 1. That means there are almost 7 paper claims for every single ounce of actual deliverable metal sitting in the vault, which is insane. It's a giant game of musical chairs, and the music is stopping. So while retail traders are busy trading off of war headlines, what are the actual Wall Street vultures doing, allegedly? They are urgently accumulating physical silver faster than the new paper shares can be printed. The Sprott Physical Silver Trust just doubled their equity program to raise $2 billion specifically to acquire physical bullion. At current prices, that one move alone could swallow up nearly 16% of the entire Comex registered inventory. And then you have our old friends at JP Morgan, you know, the guys who were fined $922 million for manipulating precious metal markets. Well, data from earlier this year showed them issuing 99% of the delivery notices for 8 million ounces of silver in a single month. Traders are literally rolling their futures contracts backwards. They are paying a premium to take immediate physical delivery right now, rather than waiting for the normal expiration date. Institutions are abandoning their trust in promises tied to paper silver. They are front-running a massive physical shortage, leaving retail holding a bag full of paper IOUs. They know that when the vaults run dry, the exchanges will just force cash settlements. I mean, allegedly, that's what they know. At that point, your paper silver ETF is just a digital number on a screen that they control. So instead of giving you actual silver, they're just going to give you cash, and the number is something that's generally kind of a little bit tied to reality, but they control it. Me personally, my rules are the exact same as they've always been. I'm sitting on my hands. I do not touch paper ETFs like SLV. If I can avoid it, which I 99% of the time can. When the silver pricing mechanism is this broken, it just doesn't make sense. I stick to physical hard assets that you can actually hold in your hand, and then, you know, store them in a vault. Don't store them in your actual hands, because if you live in the UK, you probably shouldn't, because if someone breaks into your house, you have to shake their hand, offer them a biscuit, and help them load your silver into their car, because that's how the UK works. Anyway, whatever. Because in a world where every financial product is basically broken or has massive counterparty risk, physical metal makes no promises and it pays no interest. It just kind of exists. Are you holding physical silver, or are you trusting Wall Street's paper bullshit promises? Let me know in the comments below. I'll see you in the next one.